Are you a self-storage owner or operator looking for service providers to help at your facility? Well, the Storage Business Owners Alliance, also known as the SBOA, has you covered. The SBOA is a premier online hub for connecting self-storage owners and operators to industry-leading products and service providers. We provide one-stop shopping for your business with exclusive offers to save time and money. At the SBOA, we believe by coming together, we help owners and operators grow revenue, gain purchasing power, reduce expenses, improve efficiencies, and increase profitability. We also offer many resources such as our conferences and self-storage unlock webinars to help self-storage owners and operators gain the knowledge needed to become more competitive in the industry. To become an SBOA member or to find out more information, please visit www.thesboa.com today. We can't wait for you to join the Alliance.
Good morning, everyone. My name is Jessica Johnson. I'm the Vice President of the Storage Business Owners Alliance. Thank you for joining us again for another Self-Storage Unlocked. I apologize, I'm sitting so close to my screen. I'm having issues with my speakers, so I'm sitting very close so you can hear me. But welcome. Today we have a great session, and I'm actually off the hook from hosting today because I am joined by the president and co-founder of the SBOA, Ian Burnstein. He's going to be hosting today. And the commercial you just saw before we got started, we have another Storage for Rookies session next Thursday. That is for newer owners and operators looking to get into the business, or current owners and operators that may be looking to scale the proper way. We are offering to people out there, if there's a friend of yours, someone you know that's looking to get in the industry, and you refer them to that event, for your facility, if you have a current facility, you will get a free mystery shop from our new mystery shopping program, which I'm going to go over at the end. So let's get started. I'm going to bring Ian up so he can introduce his panelists for today and get started on this great session we have for you. Hey, Ian.
How are you? Thanks everyone for joining. It's good to see
we've got
everybody.
a full house today. Ian, give the audience a little rundown about who you are real quick, and then we'll get your panelists up here.
Oh, it's an exciting story. I've been in storage now for 23 years. Started back in 2000, early 2000, and just like everybody else, most people kind of stumbled into it, and it's been great for me. So back in, we owned over 100 assets in 8 states. We've since exited them all and looking to get back in when the time is right. So hopefully that will be soon. Still looking at a lot of opportunities. But the most important part to share with everyone here was back during the recession. Obviously, times were not fun. And so increasing revenue was never going to be a possibility. So I started working together with a bunch of other operators to try to work with the same vendors to try to decrease our costs, our expenses. And it worked. And so it worked so well that we formed the SBOA and decided to share it with everybody in the storage industry. And our model has been to try to find better opportunities for not only increasing your revenue, but decreasing your expenses, working with vendors to try to provide some better pricing. And so that's really what we're focused on now. Doesn't seem a whole lot. I mean, it's definitely gonna be a lot different than 2008. I don't think we'll see anything quite as extreme, but we're going into some tough times here right now. And so the SBOA can really be your friend in the way of trying to help find good opportunities to improve the outcome of your business. And that's what we aim to do.
Awesome. Thank you for that rundown. A great rundown. All right, I'm going to let you take over. We have Adam up first. Let's get Adam up on screen. Calling Adam. There he is. Adam, just make sure you unmute yourself.
Yep, there we go. Morning, Ian. Morning, Jess.
Good morning. So Adam, thank you for joining us. I have personally an incredible history with the BSC group. I can't say enough good things about them. They've financed 70, 80 properties for us over the years. And they always deliver, and they're just great guys to work with. So Adam, you're with a great shop and doing lots of great things. So I want to start with you and ask you a question. So From a financing and lending perspective, what do you say are the most important items to you when reviewing financial statements?
Sure. So yeah, thanks for having us, Ian and Jess, and putting this together. For us, because we are mortgage brokers, so we're going out and financing properties. Our key financial statement is going to be the income statement or the profit and loss statement. That shows where the money is in the facility, revenues and expenses. And I would say secondary to that would be still important, but the balance sheet to understand cost, to understand, that can help you understand outstanding debt on a property, and also just what the facility cost, and that plays into what we do in the brokerage side of things and the lending side of things. So the income statement and the balance sheet are super important to us, and not that the other financial statements are not important to us, but I leave those for the smarter the accountants and all of that. But those two are important for us.
Yeah, there's no doubt about that. So kind of discuss for everybody here the loan adjustments and how interest, amortization, depreciation, and one-time expenses play a role in the process.
Absolutely. So getting back to that income statement, you're looking at revenue and expenses, and what we focus on, kind of the core of what we're trying to do when we're underwriting a property that we're going to go take out and get financing for, is we want to arrive at a true operating income. So what that means is making some adjustments to the income statement. So if you have your, revenue side, a lot of times there's not as many adjustments, but on the expense side, from a basic P&L, what we're taking out is we're pulling out your amortization expense, we're pulling out your depreciation expense, we're pulling out interest expense. Those belong on a profit and loss statement, absolutely. But for what we're trying to present to a lender, we want to arrive at a true distilled operating income. In addition to those expenses, if you do a massive capital repair and you have that on your profit and loss statement, we're pulling that out because that's a capital expense. Again, it's fine to be on the profit and loss statement, but we want to distill down to pure operations, what it costs to run the business. So those adjustments are really important. And, even people that are super experienced, I sometimes have the conversation and they forget, I forgot you pull out amortization, or I forgot you pull out depreciation. So those are some of the things we work on very routinely with borrowers.
Do you find there's a lot of pushback and back and forth with lenders to try to really understand what the true numbers are? And obviously there's a difference in what lenders are willing to accept. I mean, for example, sometimes people will charge lower management fees, or they don't put all the payroll in there. I mean, tell me a little bit about your experience and challenges you have with lenders and trying to explain that to your clients.
Absolutely. So those first few items I just talked about, depreciation, amortization, interest expense, those are pretty much no-brainers for a lender. They understand those get pulled out. But like you said, a lender may be used to seeing a 6% management fee, and we have to make the argument this borrower is self-managing. They're paying themselves 4%, or they got a management company that's only charging 5%. So that one is less of an uphill battle, the management fee side of things, than other adjustments. So let's say someone's discontinuing something on the advertising side, or they made one of those big repair items. We generally have a pretty good amount of success with those items. But what is key is footnotes, because if we just go, oh, by the way, I forgot to tell you we made this adjustment, and there's no support for it, a lender goes, I can't really just go on your word. I need some support for that item. Some of your expenses are going to be what they're going to be. You're not going to make any adjustments. And then some of them, it's very important to adjust. Not to get too deep into this, but one thing we see is someone may pay for, if they own a property, they may pay for their car through the business, or auto insurance or something like that. And they say, hey, that's not true operating expense. So we'll pull that out. We'll make an adjustment. And we have a lot of success doing that. But you're right. It's not always just as easy as, okay, we accept all of these things. The lenders will ask some questions back and forth, and they'll want some support for those adjustments we're making.
Great. And then just the obvious question. So what have you been seeing on the two real big factors once you kind of finalize the numbers are obviously going to be cap rate and proceeds. What have you seen lately on the trend of cap rates that lenders are willing to apply? Obviously, they've got to be going up with interest rates going up, correct?
Yeah, absolutely. And what's nice is it sort of comes down to what the appraisal concludes in a way. If the appraisal concludes something the lender just, boldly does not agree with, that's one thing, but they generally rely on the appraisers. And we are seeing some cap rate movement upwards, in not one for one with interest rates, but we're certainly seeing it, which is impacting values. And from a proceeds standpoint, we're in a time, Ian, that debt service coverage ratio is the main driver. We're still not even seeing, values being the constraint, and then something called debt yield, which is another metric, is not as much of a constraint. It's debt service coverage ratio, because that is directly linked to what your debt service is and what interest rates are. So as interest rates go up, holding your net operating income equal, your debt service coverage ratio comes down, and vice versa. In a low interest rate environment, your debt service coverage ratio is up. So we're seeing proceeds constrained by debt service coverage ratio, which makes it even more crucial and critical that when you go to, acquire a property or refinance or whatever it is, you make those adjustments we just talked about, so that you're not handicapping yourself for something where, you got an extra $8,000 of expenses here that you could have adjusted out. When you make those adjustments, it really helps your bottom line. And it's nothing nefarious. It's not something you're doing wrong by making those adjustments. It's just that, financial statements have a lot in them. Profit and loss statements have a lot in them. And it's important to make those adjustments so you're kind of putting your best foot forward.
Sure. It's you hate to see people get surprised. I mean, in today's world, up until 6-7 months ago, you could really pay a low cap rate. Lenders weren't afraid. They would still give you proceeds. They'd acknowledge the cap rates. I think today, you'd agree with this. As kind of a word of warning to everybody, just think a little more conservatively. And if you're counting on 75% proceeds at a 5 cap, you got to be more practical. I'm sure you're seeing that every day, where people are either not getting the proceeds that they pro forma'd, or not getting the valuation they pro forma'd. So I think it's just anything you want to talk about from personal experience. You got to be seeing that all the time, right?
Yeah, absolutely. And you touched on something that's really important is, even before debt service coverage ratio constraints were such a factor. People were getting a little nervous with the COVID times and beyond, with what's going on with our economy, where lenders that were previously saying, yeah, we can get you to 75%, or even we can get you to 80%. They're saying, hey, that's scaled back. We're getting to 65 to 70%. And that's partially debt service coverage driven, of course, but it's also partially just lenders saying, hey, we don't want our borrowers overextending. And sometimes borrowers struggle with that. And I will say to them, it's not totally self-serving for the lender. They're looking out for you as well, because what we don't want to happen is a value adjustment down the road and you have trouble getting out of your existing debt into something new. So being more conservative, of course, if you see something where you think rates are deeply under market, that sort of strategy, that's working for people. But, we have to temper our expectations. One quick anecdote, I just spoke to one of my buddies who's an appraiser yesterday, and he said he was working on something where the guy who he was appraising for was expecting something like 50% rental growth in the first year. And he said, hey, I understand that, I can see the numbers, that your market, your facility is below market, but 45% in 1 year, that's a pretty big number. And so tempering expectations about how much rent growth is going to continue in the market's really important, and having a realistic pro forma. It's great if you perceive that there's a lot of opportunity to grow revenue, potentially shrink expenses, but you have to look yourself in the mirror and be realistic about your assumptions, because if the deal doesn't work under some stress testing, whether it's stress testing with your interest rate, adjusting your interest rate sensitivity, or your expenses or your revenue growth assumptions, it might be too tight of a deal. If it doesn't have some cushion, you very well may find yourself in a situation where your facility can't cover as it needs to.
Right. I guess the only other real readily available solution would be if you really believe in the project and you can't get the proceeds, you're just going to have to raise more equity.
Absolutely.
And last thing, just before we switch over to Jane, would be tell me a little bit about explain to the group here the differences between recourse and non-recourse debt, and on top of that, obviously recourse is less preferable. So what kind of available non-recourse? Non-recourse seems to be much more readily available in a good market. Obviously, tell us a little bit about what you're seeing today with non-recourse versus recourse.
Absolutely. So just a quick brief on those two items. So recourse debt being such that what a lender could come after or pursue in the event of a default is much more broad. They can come after personal assets. It's the recourse is more than just the property, more than just the business itself. So they can come after other assets. Non-recourse being what a lender can pursue in a loss situation and default situation is typically limited to the business and its cash flow, its rent, PP&E, all those things associated with, let's say, just the self-storage facility. So You're right. In a better environment, non-recourse is a little more readily available. Right now, non-recourse debt is still out there. It's still available, but it's available at lower leverage points. And, it's sometimes restricted to more capital markets products like CMBS, which we don't need to get into too much what that is, but recourse right now is kind of in vogue. It's less preferable maybe to borrowers, and it puts you on the hook for more liability if something goes wrong. But it does go back to, you kind of have to put your money where your mouth is. If you believe in a property and you think you're going to be able to do all the things you want to do in your business plan, you have to be able to back that up. Now, that's not to say that you should be getting into a recourse loan situation at the absolute max leverage, and it doesn't seem like your property is going to cover. You need to be realistic again about your budget and your pro forma. But non-recourse debt is great. It's what we tell people when we're moving them from recourse to non-recourse. Is it's nice to be able to remove contingent liabilities from your personal balance sheet. So what you're on the hook for if something goes wrong, and a lender that's looking at a borrower that either has very low debt or very low contingent liability. Lenders are in a lot of cases more willing to make loans to those borrowers than someone that has, they got 10 properties, they're all recourse loans, and, they're on the hook if anything goes wrong. The last thing I'd say about the non-recourse versus recourse situation is just a note on construction quickly. A lot of people will call us and say, hey, I'm looking for 75% leverage, non-recourse debt at the most attractive interest rate you have. And I say, that's great. I would love to have everything I want in the world too, but sometimes it's not quite so easy. Right now, non-recourse construction financing and storage is not super readily available. It's harder to find. A lot of the common loan products we're putting people into on the construction side, for example, I'd say 90% of them are recourse loans. And on the conventional side, if you're permanent debt, if your facility is already cash flowing, I would put the clip at more like 70% of those opportunities are recourse debt. But if you can get low leverage debt, if you're at 50% leverage to 60% leverage, there are some non-recourse options out there. But if you're looking for, and especially sort of speaking to this group, which I think has a lot of newer operators, newer potential entrants into the market, if you're looking for higher leverage because you don't have millions and millions of dollars sitting in your bank account, and you're like me, you just have some money you want to put into a storage facility, and you're looking for that higher leverage for your first facility, you're more than likely going to be signing recourse on that transaction.
Awesome. Okay, Jessica. Oh, do we have a question or nope? Okay. Do we now want to switch over to Jane? There she is. As I described Jane with the perma smile. Jane, thanks for joining.
Good morning. Good morning.
So let's start with you and ask from a broker's perspective, what are the most important items you are encountering when reviewing financial statements?
When we are underwriting properties, hands down, the most important one for us is going to be that profit loss statement. That is going to tell us a whole lot. And what we're going to start with is obviously that top line, and we're going to see how that ties to their management software. So that's going to reveal to us a couple of things. One is the cash actually making it to the bank is likely going to be indicated here if it's actually hitting your financial records as well. We have still a lot of small operators that sometimes are still in the cash business. And so moving forward, that's going to become even more important on the financial side and keeping good records. Whereas these past couple of years in a really competitive buying environment, the lenders were not as concerned with some of that. But I think as everything kind of gets tightened up, we're going to need more of that proof of existing income. Traditionally, we always underwrote on a trailing 12. And then when we were seeing that rental growth of, the 20%, 40% rental growth, we started doing a trailing 6 and then a trailing 3. And so I think you're going to see over this next year where we are actually going to have to go back to more of that traditional underwriting, looking at more of a conservative history, like Adam was talking about earlier. So that profit loss statement is going to tell me that, for one, if it's truly tying to their management software. And the more it ties with your management software, the more real that is, because of course it's more likely to tie with your bank statement as well. The other thing your profit and loss statement is going to tell us that your management software might not is if you have other income producing property as a part of that company. So you may have retail storefront that you don't run through your management software. So it's not an all-in-one thing. Just because you have a management summary for the year or something, that's not going to tell you everything about revenue possibly that you need to know. Oftentimes, things like truck rentals aren't tracked on your management software either. So it's going to give us that full kind of look at the income statement. And the more we can tie to those other reports, the third-party reports, the truck rental reports, the retail storefront leases, the more that income becomes verified. And then from there, we're going to be looking at the expenses on that profit and loss statement. And as Adam was talking about earlier, so I don't want to repeat everything he has said, but he already talked about the things you're going to be pulling out of that income statement that's not associated with underwriting. Another way of looking at that is when you look at that income statement, think in terms of what will stay with the property when you're underwriting it. So obviously that person's debt carry and how they finance the property and that interest amount is not going to stay with the property. Obviously the new car that they decided to purchase through the company, probably not going to stay and be something that carries forward with the property. So when you think in terms of, you don't have to blow your mind about now, what did they say to include or not to include? Just think about what's going to stay with the property when you have it and how you are going to operate it.
And is there some way that you notice that things, seem out of alignment, or can buyers quickly figure out through due diligence where there's holes in it? Are there general black flags?
Yes, and I know. Yes, and I think RK is going to cover more line item percentage details later, but just in like the back of the napkin, quick look at everything, you can look at your total expenses. And generally speaking, between 28 and 32% is what you're going to be looking for in expenses. I do want to caution you if you're new to the industry, because sometimes people will get kind of caught up on the expense ratio and try to figure that side out when it's out of whack. But you need to understand that you may not be looking at market rates. You may have someone who doesn't understand revenue management. And so that facility may have what appears to be high expenses because they're 40+%, when truly they've just got low income. So don't just think that you can go in there on your line items and do something different with your expenses. Sometimes it is your top line with your revenue side as well impacting those expenses. You can also tell what we see the big lines that we see the most wrong in or have to have adjustments is repairs and maintenance. We'll be like, oh, wow, what's in that number? And they're like, oh, well, we bought 100 new doors.
Right.
So that doesn't, yes. And so just think about when you're looking at your expense statement, also, it doesn't belong on your expense statement if you're not going to continue to have that cost, is another way of putting that. It goes over there on the balance sheet to be amortized. So you're not going to buy 100 doors every year. So that number doesn't go on your income statement. I think sometimes we get the newer to the income statement thinking folks may kind of get a little bogged down in some terminology, but I think you've just got to use some common sense when you're looking at your income statement and think about, is this what I'm going to have to do again every single year? Sometimes that's monthly, sometimes you have annual cost as well. So we're looking to make sure that those things is what's associated with the underwriting.
Yep. Good. Another item, which I'm sure, and maybe we bring RK up now as well. But to me, the largest issue that I have experienced as a buyer is real estate taxes. And, Jane and RK and, and Adam, all of you guys can attest to this. But to me, I mean, only once have I hired a consultant that really missed the boat on a property, and it really changed our performance. I mean, they were off by the tune of $35,000 a year, which is a huge number. So, and you put that at a cap rate, that's a huge number. But luckily we own the property long enough and we're able to recover from that. But maybe talk about Jane, you first, and RK, a little bit about what you do from a perspective of your client. What do you advise them to do when buying a property with respect to property taxes?
You're going to have to assume, as much as we kind of sometimes know what that word can mean, but you're going to have to assume that the property taxes is going to be reassessed. Now, what year you actually account for that, because some municipalities are a little bit slower to make that happen than others. So oftentimes we'll see it settling in year 3 when they should account for that. There's some things during the transaction that can oftentimes, when you, instead of having everything accounted for real estate, there's some other things you can do towards goodwill to offset some of that. But you basically have to assume that you're going to be reassessed at your purchase price based on, and you speculate that it's going to be that current millage rate. You can also look at your municipalities and see how that they tracked in the past. If you're looking at investing into a facility, when you get a better feel for that county's balance sheet and their financial status and where they're going to be in financial trouble from a municipality perspective, will oftentimes indicate whether or not you're going to have that impact on property taxes and how substantial that is. The difficult part from pushing it out on our end is in the past couple of years when we do the call for offers, because they have been all over the board. And so fortunately, those call for offers are on the high end of the purchase price. And so those buyers can underwrite their own reassessment according to what they're willing to pay for the property.
Got it. RK, anything you want to add? I mean, do you use consultants, use attorneys? I mean, to us, we wouldn't buy a property without, spending the money and the time to really dive in. I mean, Michigan, we know really well, understand the tax, but we're going to a new state, new municipalities. There's different ways of calculating when they cap, they uncap. I mean, it could be a disaster. I mean, I know Texas, for example, there's not a lot you can do, right? Texas is kind of free will to change taxes whenever they want, right?
Yes, and it's kind of a dicey situation. I have for the longest time used Michael Donahue at Storage Tax Specialist, who I think is one of the industry standards go-to guys for property tax certiorari work. Michael's done more of that than anybody else. And, every consultant can potentially make a mistake and be off $35,000 as you were in your case, but that's a pretty rare occurrence that happens, particularly with guys like Michael, who have probably been in almost every county in the United States. So they know how that county treats taxes, and they're able to go back and make phone calls and oftentimes have relationships with people in the property tax office where they can go to the assessor's office and have a frank and honest conversation about what is the market value going to be? Is this going to be more reliant on your per square foot numbers from your Marshall Swift? Is it going to be tied strictly to the purchase price? It's going to be driven by the market, so the cost is not nearly as important. Or are you going to ask for income statements from all your operators and go straight to the income statements, put a cap rate on it? I mean, those 3 evaluation methods, which every appraiser uses, are also used by the municipalities. But first and foremost, Janie's idea of you've got to have a good feel for your property taxes is super, super important, not only from an acquisition, disposition, or finance perspective, but just from an operating perspective, so that you know what that big number is going to be every year. And it's great that you're able to maybe push off your property tax implication past the first year because of the timing of your closing and the assessment date, the date the grand roll is updated. And keep in mind, some municipalities only update the grand roll every 3 years. So you get a pretty big pass in there for a few years. You can kind of coast along. But it's a mathematical function. That's about it. And I would agree with Janie that you take the worst case first. And Adam used a word. He said, stress the financial statements. Well, if you take your property taxes based on market value is purchase price, and you take the highest millage rate with some increase in it, that's going to give you a worst case scenario or a full stressing of it. Anything that happens below that, if the numbers work at that number, they'll work at any number.
Yeah. And it'll be interesting too, RK, maybe you can share your experience, but after 2008, between 8, 9, 10, I mean, we appealed. I want to say at the time we had about 75. I think we appealed 70 of the 75 tax, our taxes, and I mean, it created for our sale. I mean, tens of millions of dollars on exit, just based on a cap rate application. I mean, are you, RK, thinking now as times are changing a bit here and things may have been assessed a little aggressively, do you have any plans to maybe challenge any of your real estate taxes?
That's something that it gets evaluated every single year. When that notice of assessment comes out, it goes immediately to the tax consultant and we have a conversation. Is there anything we can do here? Are there any changes in the marketplace that we're able to use for documentation that maybe the assessed value was too high even in the prior assessments? And what can we do on a proactive basis to make sure that we're paying the least amount of property taxes possible? Really important that you do that. The other thing is having a good relationship with your assessor's office makes a big difference as well. I'm very relationship driven, and in markets that I'm in, I make sure that there's a Christmas basket treat every year at my assessor's office. I want them to remember this is the guy I like, not the guy I don't like. So, but it is relational, and they'll understand your credibility better when you come to them and say, look, I'm willing to share my financial statements. This is really the value of the property. Yeah.
Yeah. And just a word to the wise for the attendees here, just understanding, what the tax rules are in each jurisdiction is really important. So for Michigan, for example, you don't get uncapped until you sell, or there's a change in ownership in any way, shape, or form. So it's a lot easier to kind of project, but other states it's not as easy, and that should just be part of your decision making. So RK, talk a little bit about cash versus accrual, what you do, what you recommend. Do you do one or the other, or a combination thereof? Why don't you share with us what you have done in your business?
Yes, so sometimes it's a matter of where the information is going to go and how it's going to be used. The purest is probably just a straight cash basis, which means that every dollar that comes in gets recorded, and every penny that goes out equally gets recorded. And that's great because it gives you a true picture of what your net operating income is at the end of the year. However, that's not really how we want to look always at it. So maybe what we want to do is to look at a modified cash basis. On a modified cash basis, it may mean that I take my property taxes, which I only pay once or twice a year, and I spread them evenly over the year so that I can budget well for it and know really whether I'm in profit or loss. And the same is also true of insurance costs. Insurance don't typically have as many implications as property tax, but that modified cash basis or modified accrual basis just allows you to put those numbers in there. On the opposite end of the spectrum is a full accrual. And an accrual statement is fairly complicated, Ian. I mean, you really need to have your CPA and your financial advisor in on it, because you're going to be taking into account all your depreciation schedules, your amortization schedule, which can be very complex. It'll take into account invoices that have not been paid that are sitting in accounts payable. Maybe income you haven't collected yet. You have a cell tower and you're collecting money every month on that. A lot of it has some.
Or if your rent is generally pretty choppy. I mean, you get people that don't pay you for 3 months. It's still billing as income, and then you take the adjustment.
And also, you got prepaids can be a big issue too, where you have a client who pays for a year in advance. And really important is if you're offering them a discount in the 12th month, for example, on a pay for a year in advance, that can have a pretty big impact on your statement if you don't account for it properly. So yeah, it's complex, but you know what, at the end of the day, we need that information to operate our businesses on a daily basis. And that's the most important thing, is getting that financial statement to work for you. Right. Now, I would say you have a core statement that you always use, that's always go to, it's always accurate. You may take that out of QuickBooks and export it into Excel, and then that allows you to manipulate that data a little bit and to make like adjustments for Adam. So for example, you're going to finance and you've got those big capital expenses, you can put a side column, show the adjustments, and now you have a before, which ties to your income statement, and an after, which ties to your actual operating. But being able to document that and then having invoices to back up everything that's in there, if there's a paint job or if whatever it might be, just make sure you keep those invoices so that when Adam asks the question or Janie asks the question, you're easily able to say, oh, yes, that's right in here. And it's evident.
So, RK, I get, so I have a question here from Ryan Wakely, and I get questions like this all the time. Like, what is the cost to build a storage facility, or what is, like and to me, I think RK, you probably back me up on this. I mean, his question really comes about what do you ballpark on a square foot basis for insurance? And I think that's a very difficult question to answer because location is probably the most important in construction type change that equation and that calculation all the time. Would you agree with that?
Yeah, absolutely. The costs in Florida on a coastal property, on the bay is going to be entirely different than it will be in California, where there's seismic activity, or if you're in a tornado alley and you have losses in your, in that venue relative to certain weather events or whatnot. It's going to make a big difference from someone who's in, Arkansas, in a small town where there are no economic real atrocities happening, no weather atrocities. It fixes it a lot more.
One of the great things about being in Michigan.
Yeah, that's absolutely true. And when I went to work for Metro, that was one of the things that I looked at as my personal charge in charge of mergers and acquisitions was how do I balance that portfolio? Because we had a really, really big expense in the Tampa Bay market with, I think, 14 or 15 stores when I started there, just in Tampa Bay alone. Plus, we had a New Orleans store. We had a lot of exposure to coast. So when I looked at acquisitions, I saw that if I was able to do inland stuff, more in Chicago, more in Philadelphia, in those markets, it actually affected the entire portfolio's insurance costs. So you have to think smart about your acquisitions too, that if your very first one is, on the Delaware shore, you might want to think about going inland for that first one, just as a side note.
And it's not getting cheaper as weather patterns are getting more extreme. It's real. Real quick on Adam, we have a question here from Wayne, just talking about if the property is owned by a corporation, how does that affect recourse? Whether I get a recourse loan. I'll let you answer that.
Yeah, so I think the biggest tie or the biggest prerequisite on whether you're going to be looking at a recourse or a non-recourse loan is leverage. And so that's the biggest thing that we look at. And then after that, and I'm not sure, I just want to make sure I'm understanding the question right. But if it's owned by a corporation, a lot of times what we'll end up having is a corporate guarantee where you may have, the business or the corporation is guaranteeing the loan rather than someone personally. But I would say that in general, it doesn't matter if it's a huge corporation that owns the property. If they're working with a lender that is typically a recourse lender, or they're playing in a space that's a leverage point that's typically recourse, you're going to a lot of times have a bank that prefers recourse. Now, if it's a really huge financial statement and someone's got, and when I say financial statement, balance sheet, you got a lot of net worth and liquidity, and the corporation has that as well. You may be able to, there may be some wiggle room to say, hey, we're a huge company. We own all these assets. We have very low debt. Even at this above typical leverage point for non-recourse, can we consider getting a non-recourse loan? And a lender may or may not say, sure, that's okay. But again, going back to what drives it most is going to be your leverage and also what type of lender you're working with. Again, CMBS lenders, that's a non-recourse product by right. CMBS is a little bit of a tough product right now because of where interest rates are, but that's a non-leverage or a non-recourse product, whereas a lot of local, regional, mid-sized banks are going to prefer recourse. Same with credit unions, and then insurance companies are sort of a toss-up whether they'll allow non-recourse or not. But I hope that answers your question, Wayne.
I'll add. I mean, from my experience, and just answering Wayne, it won't make a difference. There's other calculations whether you're trying to get to a recourse or non-recourse, but if they want, whether just by setting up, putting it into an entity won't change that calculation at all. They still want personal guarantees and personal assets. But what I would tell I would advise everybody as a word of caution. I mean, we had 100 assets. Every one of them was owned by a different LLC. And I recommend everybody do that so you're not exposing any of your personal assets. Now you can always, there's something called, the old attorney in me, I've been an attorney over 20 years, but there's something called, piercing the corporate veil, and they could potentially get to you if you don't do things right. But generally speaking, you want an entity to own each of these assets, and a way to simplify things, I'm probably getting a little too technical here, but each entity was a disregarded or pass-through entity for tax purposes, but for liability purposes, it protected us. And so if you could have one entity as an owner owning 10 properties, but if you had like a slip and fall or some kind of accident at one property, they couldn't go after your assets that were owned by another LLC. And so I strongly encourage everybody to do that.
Adam, isn't it generally true also that the lender is going to want that to be in a bankruptcy remote special purpose entity all by itself, so that for their protection, as well as Ian said, for his protection, both sides would like that in that remote entity, and that remote entity will have to go outside of it, whether it's a corporate guarantee with a deep balance sheet or a personal guarantee to get to the recourse side of it. Is that not still appropriate?
Absolutely. Yeah. Using the term SP, single purpose entity, pretty much every property that you buy or that someone buys has its own LLC or its own ownership corporation or ownership entity. And like Ian said, that can roll up. You can have 10 properties owned by a sponsor, but each property should be in a single purpose entity, a bankruptcy remote, or whatever the legal language is that Ian knows more about than I do. But yes, that is very true that each asset is put in its own ownership entity.
Yeah. So this may be the best question I've ever heard. It's from a guy by the name of John Price. Really brilliant. It says, regarding financing with the volatility in benchmark rates, for example, SOFR, are any variable rate loans getting done? And how does an owner plan around interest rates volatility, given the hedging costs are likely prohibitive?
That is a great question, John.
I mean, it's brilliant. It's brilliant.
To take that in two parts. The first one is very simply, yes, there are variable rate loans getting done. So whether you have something that adjusts monthly or something that's quarterly or even, every year. And so that's kind of your true floating rate debt. Whereas you have variable rate debt that may be fixed for a period of time during your term. So I just end of last year closed a loan that had a 15-year term, and the rate was fixed for periods of 5 years at a time, resetting every 5 years based on the spread, which is set at the beginning and doesn't change, but the index will change. So 5 years from now, that'll reset to the then current, I think, 5-year treasury plus whatever spread. And then your question about how do you plan around interest rate volatility, given that hedging costs are likely prohibitive, is an awesome question and is about as relevant as it gets right now. Yeah. We came out of 2022 with rising interest rates like we haven't seen in a while. We've certainly seen the interest rates we have right now before. This is not new territory, but it was pretty unique the way that they rose and how quickly they rose. So to answer that question as best I can, I would say we're sort of expecting now that we're not going to have another year of as significant of interest rate rises, but we have the Fed meeting in a couple of weeks here where they're probably going to raise rates again. So the way you plan around that is going back to what I alluded to earlier is kind of stressing the property. So if someone sends me a pro forma and they have an interest rate in there, first and foremost, I'll adjust it and I'll say, hey, here's where rates are today based on our experience. And if we're going after something that's fixed rate and we know with a good degree of certainty what that rate's going to be, that's less of a puzzle. That one we can say, okay, here's where we think the rate's going to be. It's going to be fixed for a certain period of time. If we're working with someone that's a floating rate lender or even a variable rate lender where the rate is not fixed for the entire term, it's super important to stress your interest rate against your projections, against your profit and loss statement, because if you end up in a situation where you're budgeting one interest rate and you don't do any sensitivity testing, and that's a floating rate loan, and like John alluded to, you either can't you can't hedge it because of the type of debt instrument that it is, or the debt instrument to hedge it is very expensive. You need to be stress tested. Yeah. So whether it's 25 basis points a year, 50 basis points a year, I will say I don't have the crystal ball. We don't have the crystal ball on where exactly rates are going, but it is definitely important to stress test and say, Does this, does this property work at a 6.5% interest rate? Okay. Does it work at 7? Does it work at 7.25? And of course, you're going to buy a property hoping that you can raise revenue, potentially, have some expense savings, that sort of thing. So there's going to be some growth, and you want to consider that. But you also don't want to just, use your best case scenario every time, because then that's how you get hurt. That's how you get to a position where all of a sudden the rate that is the going rate at, year 2 is your interest rate's gone up, and you didn't account for that when you were looking at purchasing the property. And if your business plan hasn't gone exactly as well as you had hoped it would, you might be in a tough situation, and you might be dealing with a situation where you can't cover your interest costs. And then the bank saying, hey, it's a recourse loan, you have to cover these personally, that sort of thing. So that's a really great question.
Yeah, John, thank you for being here and asking that question. You're wonderful. So this goes to Jane and RK. Talk a little bit about expense ratios that you guys use when evaluating properties. Jane, obviously from the buy and sell side, RK for your business. And RK, why don't you answer first, and then we'll have Jane's response.
Yeah, the biggest challenge that you have is the property tax issue, because that's going to move the needle the greatest on your expense factor. If it's Arkansas, for example, that's going to be entirely different than it's going to be in Cook County, Illinois, for example. I priced a project $85,000 net rentable, and I went to market to find out what the property taxes were in Cook County, and the projected property taxes with $2 rents was $350,000 a year. That may be the entire expense factor for an Arkansas 85,000 square foot property, or an Alabama 85,000 footer. So you have to first qualify where you're at in terms of property tax. Second would be likely the insurance is a pretty big variable if you're coastal versus non-coastal. And then the last really big mover tends to be payroll as well. So you have to understand where you're at in the payroll scheme of things. I think that the Almanac last said that we were somewhere in the neighborhood of a 38 to 40% expense factor is a pretty good range to kind of plug in. I like to use some fairly fixed expenses. Like, I know that my payroll cost is going to be somewhere around $85,000 a year for a property. Now, keep in mind, that's with all the burden. That doesn't mean I'm paying them $85,000 a year. I'm only paying them 50 something by the time I pay insurance and 401k and time off and all those things. That
Payroll
all adds
taxes.
up. Exactly. That's 13% right there. Right off the bat, you're going to click out 13% increase for that. So, knowing all those things are very important as you try and come up with that composite expense factor. The other thing is how big your facility is also makes a huge difference, because if you're generating $10 million a year in income, well, that's a totally different story than generating $1 million a year, because that percent is going to tie to it.
No, that's a great point. I mean, our largest properties were inevitably, generally speaking, not always, but are more valuable, more profitable stores. You're right, because you didn't necessarily need more payroll, didn't need more marketing. You didn't need, there's certain things you just didn't need more of, and so you could amortize across. So Jane, RK brings up a good point. So are you kind of looking, assuming 38% or so is a good average? So, are you, when you're looking at properties with clients, or is part of your calculation, well, maybe an area like Cook County, where I've had some challenging experiences as well, maybe those aren't good markets, because it may take just based on taxes alone, it could take your expense ratio up in the 50s, even 60%. So tell me a little bit about, what you're looking at for your clients and what your, kind of your process is.
Yes, echoing what RK said, the biggest thing is a few things. What are you taking that percentage of? What size of that? So sometimes it gets taken out of context as to what we're looking at. So everyone, when they're looking through their numbers, they really just need to do a common sense gut check on it as well, as to kind of drilling down on those line items of what does that mean that they would be doing with those dollars on a month-to-month basis. You've got 85,000 in payroll, like literally, what does that mean for your facility? And does that even fit for that size? The big thing that we've seen in the last couple of years with the technology that has been made available is the different management platforms. Whereas that, 38% was, a gimme, but now you can do that, many folks are doing that much more efficiently. So it depends on what type of property that we're actually underwriting. Is it going to be where we need 85,000 in payroll, a person and a half or 2.5 people there on a full-time basis? Or is this going to be something that is added to a portfolio where it's an unmanned location,
Right.
not to be confused with unmanaged, but those expense ratios in that payroll, when you're absorbing, sometimes you can absorb a location and not truly take on a lot of additional overhead because you already have your operations set up.
Yeah, no, it's a great point. I mean, you can, we have a question here from Ryan Mitchell, which I'd like to hear everybody on, but I mean, he asked, could you touch on underwriting assumptions related to P&L for a value add property? What are these based on? What sources are best to use? So it's interesting, kind of based on Ryan's question and what Jane just said. So there is a certain management company out there that took over a lot of properties back in 2008 that were in receivership that we ended up buying quite a few of. And based on the way that they were billing and getting reimbursements from the property and the way they were dealing with insurance and keeping insurance proceeds, it looked like we were paying a very, very low cap rate, when we knew from our extensive experience of managing our properties, it may have looked like on day one we're paying a 4 or 5 cap, but the day we took over management, it was an 11 cap. I mean, literally that extreme, right? So based on the way we manage our own property. So and to address Ryan's question, I'd love to hear everyone's opinion here. When you're doing a value add, I think there's a lot of, if you truly understand management and either doing it yourself, or if you have a management company you trust that can do what you think they can do and execute on your plan, then it might be worth overpaying a little bit because you think you can really turn it around. The challenge, and then we'll let Adam answer, is going to be, you're likely not going to get the proceeds you want, especially today. You're not going to get the proceeds you want or probably deserve. So you may need to take a shorter term loan to address that and then refinance it once you get it to the place you want. So maybe RK, why don't you start us off a little bit? Tell me, like, when you're looking at value adds, I mean, what kind of things are you looking at the financial statements?
Yeah, good point about the financing. And Adam, you can opine on this as well. But sometimes I might go out and look for mezzanine debt to bridge myself until I can get that operating income up to where I need it, so that my permanent financing will be at a different level. But I might need those proceeds to add more spaces onto the property or a number of different things. But value add a little bit tricky, but the good news is that most of the time you have a base core of income and expenses that you can extrapolate off of. Right. If you're, for the last year, you've been booking 10 by 10s and you're getting it at $1.05 a foot, and you're going to add more 10 by 10s, it's not really difficult to do the math to just pull that out. Now, if the market is $2 and you're at $1.85, now you have to decide, am I going to be able to get my product to the $2? Am I equal in my location and my amenities, et cetera? Then that's a little bit more of a challenge. One thing I'd like to put out there is, if you really want to know how to get to a number, actually take your rent roll and figure out, when you say I'm going to increase rates 10% in the first year, that is a huge number when you actually start applying it to the rent roll. And you look at how many tenants you move out during a year, you're going to replace them at the higher rate. Good news. How many that you have increased right before that? So you may not get 2 increases in there. You may only get 1 if you're increasing every 6 months. You have to look at the timing of when you can increase them according to your business rules. And then just going line by line, you're going to figure out that if you take over today, you're probably not putting a renting notice out the day you come in. It's going to be the next month. Then you have a 30-day wait. So you've already lost 2 months from the gate, and that 10% now becomes 14%. So right. You really, really have to understand your financial statement and understand your business plan and how it folds into that statement.
Yep, no, that's true. And then Jane, I would, what we always did, which was important, I would always, first thing I would do when I was looking at a property, and which I do still today, is I go to StoreTrack and I compare the rates for everybody in the area, right? And so if I can see that current rates are 15, 20% below market and we have a superior product and it's just been mismanaged, that to me is, I'm willing to do exactly what RK said. I'm either willing to put in more equity and refinance later, or, obviously, mezzanine financing is expensive, but, I would tell you, development and value add are high, much, much higher risk, but much higher reward. And so if you either manage yourselves and you are confident in your abilities, or you have a great management company that you completely believe will execute your plan, it's a good bet. I mean, Jane, talk a little bit about how you've dealt with that with clients.
On the value add side, because when we talk with the buyers, that's what every buyer is looking for. I want a facility with value add. Tell me about your value add opportunities. So I think for one, there's a couple of different value adds, as RK was referring to, that is possibly out there. Some of it's what you were just saying, Ian. It's just a matter of tweaking some numbers, if you will, pushing some rates, and not substantial dollar investment to make that happen. Other times it is actually getting unrentable units rentable, or improving your curb appeal so that you can do your revenue management. So the biggest thing in the value add for me is, what additional dollars, which value add is it? What additional dollars is it going to take for me to get that value add in the checking account and a part of my rent roll? But your takeaway, always to live by, you don't want to put another dollar in that facility until you're getting every dime out. And so sometimes folks focus on the value add and they're like, oh, I don't have any 10 by 10s. I need to build more. I've got land right here, so I can do that. And then they're still over here with the existing 10 by 10s that are, 15 to 20% below market rate. And so when you look at the value add, just be sure you're working with what you've got and getting everything out of it, and then kind of drill down from there.
Adam, anything you want to add?
Yeah, I know we only have about a minute left, but just taken from the mortgage broker and me, revenue, you guys covered it. Go out and price shop your competitors, see what their rates are. That's how you put together your competitive assessment. And then just going quickly line by line. Taxes, what we talked about earlier, get to know your municipality, when things get, reassessed, all that sort of thing. Get an insurance quote. From the management standpoint, you have a pretty good idea, depending on who you're going to hire. Okay, they charge 5% of rental rates. Payroll, that's a little bit more of a difficult one to understand how much you need to staff, but it's achievable to figure it out. Utilities, take a look at what they've been historically, if you can get access to that and use a ballpark there. Repairs and maintenance, same thing, understanding what you need to do when you buy the facility. And then general administrative sort of falls into a different category. In terms of resources, I think you can call someone like, I don't want to push this on Jane, but you can call someone like Jane if you're working with someone that's helping sell or helping buy the property. You can call someone like me. We have a pretty good handle on that, and just understanding, doing your homework is the biggest, the biggest piece there. But that's a great question as well, Ryan.
Yeah. So listen,
You might call the SBOA, right?
What's that?
Right? Call the SBOA and see how they can help. Well,
Exactly.
By looking at some of the.
Exactly. Thank you for that. Listen, this has been an incredible panel. Some great questions. I would just encourage anybody out there, who has questions. You got 3 great resources here that I encourage you to contact. It's just a wealth of knowledge from all 3 shops and all 3 people. And so, listen, I think while the economy is challenging, I think that's where fortunes are made. And I think in the coming, months and years here, I think that there's going to be some people who can be creative and work with smart people like our panel. Those, to be honest, my personal story is we bought 70 properties between 2009 and 2012. So 20, 30 cents on the dollar, and we're not going to see, in my opinion, I don't think we're going to see 20, 30 cents on the dollar prices, because there's still a lot of cash on the sidelines, but they will be significantly discounted. They could be, call it 60, 70, 80 cents on the dollar, which is still better than what you're paying today, or you were paying a few months ago. So there's starting to be some things shaking loose. And again, your best asset is the people on this panel and others out there who can help you accomplish your objectives. So Jessica, you want to wrap us up?
Yeah, thanks, Ian, and thanks everyone for being here. I just have a couple quick announcements about some things that are going on in the industry that we would like you to be a part of. We will be back on February 3rd for another Self-Storage Unlocked episode. This one, we're going to be talking all about how to create policy and procedures manuals for your business. Have to have some SOPs out there, guys. Can't have your team running renegade on you. We want to make sure everybody's in alignment with your core visions for your business. And by doing that, you need to communicate it to them. Some SSA upcoming events, February 6th and 7th, the North Carolina seminar is going to be held in Asheville, North Carolina. If you're in North Carolina, join the North Carolina Self-Storage Association. Come to that seminar, good learning there. February 8th through the 10th in my home state of Florida, the Florida Self-Storage Association Conference and Trade Show is being held in Orlando at the Renaissance SeaWorld. You can get all of this information on selfstorage.org because these are all ran by the National SSA. February 14th through 16th, the Arizona Self-Storage Conference and Trade Show that's being held in Phoenix, Arizona. And then the big one, the National SSA Spring Show, will be held March 8th through March 10th in New Orleans. The SBOA will be there. Can't remember our booth number off the top of my head, but if you follow us on social media, you follow our newsletter, we'll have announcements about all of these events. We'll be in attendance at most of these events. So if you're coming and you're in one of these states, please stop by and say hello to us. Learn more about the SBOA, learn about our mystery shop and reputation management and storage for rookies and all of the free education that we give to our members. And keep in mind, membership still is free for the SBOA. So if you have not joined us to be a member, please do so. You can go to www.thesboa.com. Thank you everyone for being here. Have a great rest of your Thursday. If anyone's coming to Storage for Rookies next week, we'll see you virtually then. If not, highly encourage you to join us on February 3rd for another episode of Self-Storage Unlocked. Thanks for being here with us today. Take care.